All right. So now that we've covered how to identify the right business, right? We've talked about SDE, EBITDA, what types of businesses to buy. And now we've gone over the SIM and the buying process as well as add backs and talked about how private equity does acquisitions. Let's talk about how you can do the acquisition now, right? So whether you're an individual, whether you have a few partners, a few friends that might be willing to put some money together, or you want to raise outside third party capital, these are all different methods on how you can go forward and purchase a business. But I want to talk about one of the best and most common methods that occurs today with how to buy a business, especially if it's under 10 million in purchase price, which is through the SBA 7A loan. All right. And so the great thing about this is that it actually allows you to retain majority ownership and control. And it's a great way, like as we talked about with the 80-10-10 rule, it really allows you to make sure that you have the right financing to be able to take down the business and deserve and own the equity as a whole, right? So like when you get other investors involved, obviously they're going to want some sort of step up in basis. They're going to want preferred returns. But through some creative deal structuring that we'll talk about throughout the course and through utilizing the SBA 7A, you'll get access to up to $5 million of capital based upon the underwriting of the business that we're looking at in order for you to cash flow the business and buy it, right? So, I mean, the SBA 7A, again, is not a bank or a lender itself. It's a program that is a government program that basically guarantees banks that if they issue these types of loans to entrepreneurs like yourself or to future entrepreneurs, then they'll guarantee the money, almost like the FDIC for bank account money, right? So basically, banks love issuing this type of debt because ultimately they know that as long as they follow the protocols, that they'll be able to get, God forbid something happens, they'll still be able to get paid back their capital from the government. So there's obviously some general SBA loan requirements. It has to be a for-profit business. You must be located in the U.S., right? So it only applies to U.S. It has to be in an eligible industry, so nothing, obviously illegal or anything of that nature. But no, it can't work for like gambling and casinos or things of that. Um, and basically, the key goal here is that you will need to put a little bit down, like we talked about in the 80-10-10 rule, but it's a great structure used to be able to get capital, right? And so it doesn't have to be the only one. I just want to cover this one here, and we'll go through a couple different ways to finance the deal and finance the debt. But these can fund up to, you can see 80% of the purchase price, right? So the other 20% will come usually a little portion from the seller, or either doing a seller note or financing or rolling over some equity, or it ends up being a and the other 10% comes from your equity injection, basically, right? So that's how you'll put it together ultimately. Now, there's a few key interesting components here, which is like the interest rates are fairly competitive here, so it'll be prime plus 1 to 3%. So if you're watching this in the beginning of 2025, then generally speaking, that's around 10.5%, 10.2. One very interesting thing also to keep in mind is that if you have real estate in the deal, for example, like an assisted living facility, or you're buying a business, an operating business that owns the building, and the seller is willing to sell the building alongside the business, then what you might actually be able to do, if the real estate value is 50% or more than the total purchase price, then you can actually amortize it for 25 years rather than just 10 years. So it really makes that kind of loan payment and principal payback a lot better because you have a lot longer amortization. So the key thing here, though, right, is that you have to remember that there is a personal guarantee requirement. So you will be legally responsible for the repayment even outside of the business, and that, again, is a personal guarantee. And just a heads up, anybody else that owns 20% or more of the business will also have to take on that personal guarantee. So that's just something to keep in mind in the way that you're structuring deals. It usually doesn't come up, but for example, if you're only buying 70% of the business, right, and you're going to expect the seller to retain 30%, then you just have to be aware that they will also be required to personally guarantee the loan. And so, just keep that in mind because some sellers might not be comfortable with that, right? So you would have to structure it where maybe you're buying, 80% or 81% and they're retaining less than 20%. Now, if you have different partners or different kind of corporations or LLCs that are buying into, yeah, you can kind of sometimes split that up. But just something definitely to keep in mind, that buying a business with an SBA loan is a great option, but it does come with that personal guarantee, and there's no real way around that. And then They will kind of evaluate your credit worthiness, right? You basically have to have a minimum of 600 credit score or higher, but they're really not looking for your own personal tax return or cash flow. They're looking to make sure that there is proper cash flow in the business itself that you're underwriting. So it obviously helps to have experience in the industry, right? They're going to ask you to put together a business plan, which is a good idea anyway, right? It'll outline your strategy and projections for the future of the business. But what they're trying to make sure is that the business that you're buying, that they're going to collateralize, is going to have enough sufficient cash flow to support the loan payments, right? So they're actually going to analyze the financials of the business. They're going to look at the tax returns, and they're going to look at what the debt service coverage ratio actually comes out to. And so that's the key component that you need to understand here. It might maybe different in real estate, but in general, the key thing here in M&A deals is that the bank wants to make sure that the business generates enough cash flow to cover the annual debt service and then some, right? So the annual debt service is going to be the principal plus the interest. And so what they want to make sure is that you know, the minimum SBA 7A requirement is 1.15. So if your business cash flows 200,000 in a year, and in a year you have to pay 100,000 in principal and interest, then your debt service coverage ratio is 2, right? 200,000 over 100,000 equals 2. And so that's a very good ratio. You'll basically, any lender will fund you and finance the deal. Anything over 1.5 is great, and you'll be able to get funding. As you get the SBA law, the SBA 7A law, like on the federal level, is it has to be at least 1.15 or higher. So if you have anything lower than that, it's not even worth it. Around COVID, people were getting deals done around 1.15 and higher, but now today you really need to be at 1.35 or above. And so anything above 1.5, banks feel very comfortable with, and obviously anything higher than that is incredible. So hope that makes sense, and I'll see you guys in the next video.